Welcome to this video. We're going to talk about a concept that is key to long-term success in the financial markets. This is one of the most ignored and underestimated aspects of trading. Except that with Arya, the rules have changed because Arya forces you to manage your risk. We are going to talk about risk and risk management, which is vital. The majority of beginners lose money due to poor risk management, where they put all their eggs in one basket, investing everything in one go and ignoring important rules. Beginners are not the only ones that make mistakes. It happens to good traders too, and to experienced traders who make money on 90% of their trades. From time to time, they lose a lot of money on a few trades due to poor risk management. You have to accept that losses are part of trading. We are going to look at how to manage losses, and you can choose between several approaches. The first approach is having to absorb significant losses which extensively damage the portfolio, with losses of 50%, 70%, or even 100% of your capital. Alternatively, you may have small, controlled, and very limited losses which do not jeopardize your capital. This is where Arya comes into play. The protective rules mean that your losses are limited and controlled over time. We'll talk about this at more length in the coming videos. For the time being, all you need to know is that risk management rules are very easy to understand. The reasons why traders make losses, quite simply, is that it is harder to apply risk management rules in manual trading. In manual trading, you have to make calculations and apply rules. And, if you're not disciplined, you may be influenced by your emotions and fail to respect the rules. You need three components to properly manage the risks. A simple and well-defined trading plan. The plan should establish how much you will earn per day, what are your target gains, what losses you are prepared to accept, and the amount you wish to risk for each trade. The trading plan is sort of the basis for risk management. The second component is controlling your emotions. As soon as you invest your money, psychology plays a key role in terms of the emotions which arise, such as fear, greed, impatience, enthusiasm, or even ego. The rule is that you must make objective decisions which are based on rational facts and information. As soon as you let your intuition take over, the probability of losses is greater. Arya helps you to make objective decisions, showing you indicators and clear and precise protective rules. I'll talk to you about this in the coming videos. The third risk management component is money management, which will help you manage the amount invested, the stop loss, or even the take profit position. Good money management is really vital in order to perform well in the long term. It helps you maximize your profits and minimize losses, avoiding overexposure. We're going to look at a few rules to follow in order to manage risk properly, giving you specific information on how to adjust risk management. First of all, you need to adjust the level of risk per trade according to market conditions. You should avoid taking several positions in too many financial assets at the same time. We recommend you carefully choose the times you trade. We'll have a look at this in a video too. You should also carefully manage your stop loss and take profit position. Finally, tracking your gains curve is very important for improving your trading and understanding your losses in order to avoid repeated losses. We'll also talk about all these components in the training videos and how to optimally manage each aspect. Another important risk management concept is the risk-return ratio for properly managing the return on a trade. What exactly is risk-return? It is the gains you hope to secure for the capital you invested in a trade. In other words, if you invested 100 euros in a trade, you hope to make 200 euros. The table here shows you the impact of the risk-return ratio on net gains and losses. With a risk-return of 0.5 to 1, and a success rate of 50% on winning trades, your winning trade makes 500 euros and your losing trade makes you lose 1,000 euros. This means that you have a net negative income of negative 500 euros, but with a risk to return of 1 to 1, your winning trades will make 1,000 euros and your losing trades will cause you to lose negative 1,000 euros, so you have income of 0 euros. Things get even more interesting with a risk return of 2 to 1. You are clearly making money here, and your net income is 1,000 euros. What do we recommend? What risk-return ratio should we use? your potential profit must be higher than all the potential losses. This is obvious. If you make a loss on a transaction, you only need one winning trade to secure a net profit. The risk-return ratios you should go for are 2-to-1, 3-to-1. You can be greedy, but you must keep in mind that the greedier you are, the lower your chances of success are, as it requires a clear trend and a well-defined direction. In the coming videos, we will explain risk-return in detail in order to select the right ratio depending on market conditions. We will also talk about optimal Arya configuration. To round off this short video, we'll look at two traders with totally different approaches. For example, they have capital of 5,000 euros with a risk return of 2-to-1. The first trader has a more aggressive approach, risking 60% of their capital and seeking to make a profit of 120%, for example. The second trader is more cautious, more controlled, and he risks 5% of his capital, targeting a profit of roughly 10%. We'll look at the impact this has on the capital over 6 trades, with 1 trade out of 2 being a winning trade. Let's take a look at the impact. In the table on the left-hand side, which is more aggressive, we see that there are significant gains but also significant losses. After 6 trades, this trader has capital of 3,049 euros, having lost at least 39% of the capital. Now let's look at the second trader, who has a bit more of a measured approach. This time, the gains are much smaller. The first gain is 500 euros, compared with 5,600 euros for the other approach. But the losses are also limited, only negative 275 euros, instead of 6,360 euros in the second trade. In the end, what is interesting is that after 6 trades, the capital this time has increased to 5,706 euros, so more than a 14% return. When we compare the two approaches, the results in terms of capital growth are totally different. As I said, the first trader had losses of 39%, and the second had gains of 14%. This example clearly shows that risk management is vital for long-term stock exchange success. The first trader risks finding himself with capital of almost zero, 1 day after 2 losing trades. The second trader's capital is constantly growing. Keep all these aspects in mind, including risk management, and be aware that in order to be successful in the long term, you must master risk management. Arya is here to help.